Hello everyone. Today, we're discussing a key debate in investing: index funds versus actively managed funds. For most individual investors in the US stock market, index funds have proven to be a reliable and effective choice over the long term. Let's start with the basics. Index funds are passive investment vehicles designed to track the performance of a specific market index, such as the S&P 500. They hold the same stocks in the same proportions as the index, aiming to match its returns rather than beat them. Popular examples include Vanguard's S&P 500 ETF, ticker VO, or the Total Stock Market ETF, VTI. In contrast, actively managed funds employ portfolio managers who research and select stocks with the goal of outperforming the market benchmark. These funds charge higher fees to cover research, trading, and management costs. So why do index funds often come out ahead? The primary reason is cost. Index funds have very low expense ratios, typically under 0.1%, because they require minimal active intervention. Actively managed funds, however, often have expense ratios of 0.5 to 1% or more. Over time, these higher fees compound and significantly erode returns. Historical performance data supports this. According to S&P Dow Jones Indices SPIVA reports, which compare active funds to their benchmarks, the majority of actively managed U.S. equity funds have underperformed over longer periods. For example, over 20-year spans ending in recent years, more than 90% of domestic active funds lag broad indexes like the S&P Composite 1500, largely due to fees and trading costs. Another advantage of index funds is built-in diversification. By mirroring a broad index, they spread risk across hundreds or thousands of companies, reducing the impact of any single stock's poor performance. Index funds also offer simplicity and tax efficiency. Less trading means fewer capital gains distributions, which can lower your tax bill and taxable accounts. Of course, active management can shine in certain market conditions or niche sectors where skilled managers add value. However, consistently identifying those managers in advance is challenging for most investors. For long-term goals like retirement, a core portfolio of low-cost index funds tracking the S&P 500 or total market has historically delivered strong results, with average annual returns around 10% over decades, including dividends. In summary, index funds provide broad market exposure, low costs, and competitive performance that suits the needs of most investors. This is general information based on historical trends and not personalized financial advice. Past performance does not guarantee future results. Please consult a qualified financial advisor for your specific situation. Thank you for watching. If this was useful, consider liking and subscribing for more investing topics.